Hey guys, I'm Roger Herring. I am the investor's accountant. Hey, welcome to my office. Recently, in fact, Friday last week, I did a 5 hour seminar on building, preserving, and transferring generational wealth. And one of those sections in the seminar was about understanding inheritance and understanding estates. So today, I'm going to give you a taste of the absolute minimum that you need to know. Because trust me, guys, I've been through estate issues twice in the past 15 months. It is absolutely no fun. But today, we're going to talk about what happens when you inherit, what happens financially. We're going to talk about the tax issues. Okay? Are you ready to get going? I am. To the whiteboard.
Okay, guys, let's learn about inheritance. The first thing you need to know about is there is an estate tax, and that estate tax can get as high as 40%. Ouch. Yeah, and there are people in Congress that want to make that go even higher. So, there's also this wonderful thing called an exemption. And the current exemption is 13.61 million. And that's per person, guys. Now, come January 1, 2026, this goes back to the Clinton era level, which is a whopping 6 million. So that's still a whole lot of wealth that can be passed on, but not near as much. So let's assume, though, that right now there is a husband and a wife, and each of them has 13.61. What happens if the husband dies? Now, the wife has 100% exemption on anything she inherits from her husband. But let's say that they also have some children and he used, let's just call it $2 million of his exemption. So that leaves 11.61 totally unused, right? Well, not if the wife knows about something called portability. Portability means that she can take this leftover money and bring it over here and bring her exemption up to 25.22 million. That's pretty good. Well, Roger, what happens when it drops to 6 million? When it drops to 6 million, guess what? Only her exemption drops to 6 million. Okay. We still, in the grand scheme of things, have the husband's 11.61 that is ported over because there is a principle called no clawback. Once this has happened, they cannot take it away. So the wife, even with her exemption dropped to 6 million, her estate now has a $17.61 million estate tax exemption. Well, what if you're the person inheriting property? There's something that you should know about, and it's a wonderful concept. It is called the step up in basis. Basis means basically what did you pay for it, plus how much money did you put in it. Okay, the easiest way to explain this is with a real world example. My mother passed in 2022 and has her sole heir. I inherited her townhouse condo. She had originally bought this thing for about 140K way back when, 20 something years ago. And the day she passed away, it was worth $550,000. Now, under the step up in basis rule, I get a step up in my basis from 140 to 550 the day she dies, which means if I sell it for 550, my capital gain is zero, absolute zero. That's pretty cool. Now, same scenario, 550. Oh, forgot the roof. 140. But let's say this was a rental property for 20 years And now she's got $100,000 of depreciation. Normally, what happens when a property is sold, there is a capital gain and the depreciation is recaptured, meaning they are going to tax the depreciation. However, when I get the step up in basis to 550, that depreciation goes away. It never gets taxed. And I can sell this property for up to 550 for, again, no capital gain, or I can place it back into rental service at fair market value, 550, and I start depreciating from 550. And oh, yes, I can do a cost segregation. If you don't know what that is, check my other videos. All right. Well, Roger, what if, say, I had done some 1031 exchanges? What happens to then? Well, here's my strategy, guys. We call it ribbit. You know, a frog says ribbit, keep it till you croak. Let's just say that you way back when had bought a house for 50K, and then you exchanged into a house worth 100K, and you had a capital 50K capital gain stuck in here. And then you stepped up to the next one at 200 and the next one at 500. All of these steps have a capital gain. And you've been depreciating. You may have $200,000 of depreciation. Well, under the keep it till you croak scenario, all that depreciation goes away. You can sell it at 500,000 and pay no capital gains because all of these stacked up gains now go away. They are gone. They're gone. The government never gets their piece of this pie. So you can put it back into service at $500,000. You can depreciate starting today from $500,000. You can sell it for $500,000 and have no gain. That's the deal. Pretty cool, huh? So let's talk about generational assets. You know, when you are inheriting property, there are some things that are called generational assets. And these come from my research, reading some of what the experts say on this. So I'm just going to tell you about what happens with these specific assets when you inherit them. The first generational asset, and let's just title this Gen Asset. First one is land. Guys, there's never, until we colonize the moon, there's never going to be more land than we've got right now. So land is a huge one. And you know what happens to land? When you inherit it, you get a step, excuse me, you get a step up in basis. Second thing, cash flowing real estate. Now, I'm not talking about single family rental properties, even though you get a step up in basis and they're fine. But if you truly want to transfer wealth, we're talking about commercial buildings, hotels, apartments. And then you want to look at these things that are called evergreen businesses. Now, most of the time, these are industry leaders that will never go away. And the stock that you hold in them, you're going to get a step up in the basis on that. And oh, yeah, on all this real estate, when you inherit it, you get a step up in basis on it. All right. Now, the evergreen, that stock, if you inherit it, you're going to get a step up in basis. But there's more to evergreen than just something that is going to be around forever and it's an industry leader and a big guy. What about an automated business? Something that runs with little to no human intervention, and basically it's a cash flow machine. I consider that evergreen too. And when you inherit that, you get a step up in basis on it. Now, something you're probably going to scream about, the S&P 500. That's right, guys. You know what? there are a lot of experts that say once you are building the wealth, you need to concentrate in a business or in real estate, something that's going to produce massive cash flow and massive wealth. But when you switch to preserving generational wealth and passing it on to the next generations, the S&P is not a bad place to look because of its overall long-term track record and the fact that you are going to get a step up in basis on the stocks that you inherit. And the experts say Bitcoin, same thing, step up, and gold and silver. Those are generational assets, and you're going to get a step up in basis in just about every single one of them. Now, everybody wants to know, how do I avoid probate? Well, a will not avoid probate. You know what avoids probate? A trust. And because the trust avoids probate, we're going to talk about them at length in next week's video. But for now, I'm going to tell you something not to do. All right? Don't gift assets to your children or grandchildren. Do not give them pieces of land. Do not give them properties. If you're going to gift, give cash. Why? What's the fair market value of $1? Fair market value of $1 is $1. Okay? Here's your problem. Let me give you an example, and I see this all the time when parents that think they're doing right by their children are really screwing up. Here's the parent's home. The parent originally paid $140,000 for said home, and they decide to put their kid on the title, essentially gifting them half the house. So now mom has a basis of 70 and kid has a basis of 70. When mom passes away, you don't get a step up in basis based on the 140. You're still alive. So your basis remains at 70,000. Let's just say that the fair market value of this house was $500K the day mom passed away. Well, mom only owns half, so her step up is only half of what it would be, $250. So $320,000. $500,000 fair market value if you chose to sell the house minus $320 equals what? $180K. That, my friends, is the capital gain that your kids will pay if you put them on the title in this example. Don't gift assets, gift cash. All right, let's go away from the whiteboard and we'll finish up for the day.
Okay, gang, I hope you have enjoyed today's session on basic inheritance laws and what happens tax-wise with the assets. We stopped when I mentioned trusts, so next week we're going to talk about trusts. I can't wait for it. Until then, Roger out.